Our guest this week is Mac Conwell of RareBreed Ventures. Mac is the founder of RareBreed, which invests in pre-seed and seed startups. Before that, he was both a founder and an investor. We had a great conversation about the types of investments that excite Mac, how the regulatory environment affects startups and fund managers, Mac's testimony in front of the House about this very topic, and his experience of taking more than 4,000 meetings to get his firm off the ground. Mac is really thoughtful, and he's the kind of guy who makes his own luck, which I really admire. Hope you enjoy. Mac, thanks so much for coming on the show.
Happy to be here, Joe.
I'm looking forward to it. The man with the massive Twitter presence. So maybe to get things rolling, can you tell listeners about your firm, RareBreed Ventures, which is a fantastic name, by the way. I love it.
Thank you. So I have the privilege of being the founder and managing partner of RareBreed Ventures. We're a pre-seed to seed venture firm based out of Baltimore, Maryland. Our thesis is we invest in dope founders, right? That's the simplest way to put it. But to the core of it, our thesis is we invest in companies primarily outside the major tech hubs. So outside of Silicon Valley, New York, and Boston. More broadly, we invest in North America, South America, UK, and Africa. We're industry agnostic. The only thing we don't invest in is we don't invest in biotech, but we'll do just about anything else. But within that, we care about two things. One, if you're a software company, we like to see a clearly repeatable or unique customer acquisition strategy. You don't have to have a lot of customers, but you need to know how you get your customers. And we like physical products and markets that have lacked innovation in 10 or more years. You know, these nascent markets that have lacked innovation for over a decade. So that's a bit of a mouthful, but when you boil it all down, we just say we invest in dope founders.
That's great. And what was your path to getting into venture and investing in dope founders?
A really, really, really lucky one. Right? It wasn't clear. So I started my career off as a software engineer. I started off as I actually drop out of college and get a job as a government contractor with a top secret clearance supporting the Department of Defense. I did that for several years. And then I watched a friend of mine go on to quit his job and move to Silicon Valley because a bunch of guys who used to work at Google gave him money and told him to quit his job. I had no language for what was actually happening of him starting his startup and getting money from investors, right? I was just a guy who was like, oh, that's my friend. If he can do it, I can do it too. So in 2010, I started my first website. And I ended up running that for 4.5 years. The first year and a half, had no clue what we were doing, didn't know what a startup was, didn't know what a VC was, didn't even know what networking was, right? We were just 3 engineers just building. Run that company 4.5 years, 2 accelerators, a pivot, eventually sold the IP to a division of a Fortune 100 company, an amazing journey. Started another company, went through another accelerator, that company failed, lost everything, go through like the depths of like all the darkness that comes with being a startup founder on the negative side, find my way to having what I call my gap year of just spending a year working at a marketing firm. I just ran the tech team at a marketing firm, just building e-commerce websites. Like I went from being the CEO of a startup doing deals with like Disney and Viacom to running a team of junior engineers building e-commerce websites.
That's a tough gap year. It's a tough gap year.
Yeah.
It's tough to sugarcoat that. That was a tough time.
It's not much you can do with that. And then while I'm there, after being there for a year, they get a client I don't agree with ethically. So I quit on principle on the Fridays because I was like, I don't want to work with this client. And the very next Monday, I got an email from the investment arm of the state of Maryland saying they were hiring a new fund manager. And it's a community-wide email. And knowing that I had been on their email server for at least 6 years at this point, I had never read one of their emails in my life. So just so happens on this one Monday, the week after I quit this job, I see this email. I'm like, oh, that's interesting. I called one of my former mentors from when I was still a founder, who I knew worked there, said, hey, what do you think? You think I have a shot? He's like, I don't know. He's like, we're trying to do some things differently, Why not throw your name in the hat? And so like an idiot, I applied to that job and that one job only, having absolutely no understanding of how prestigious the job was, how competitive it was, how completely, utterly unqualified on paper I was for it. I just said, that's going to be my job. 4 months later, they tell me I am unqualified for the position, but that they are creating this new junior position on staff and asked me if I'd be willing to take that. And so that's how I become the first person of color on the investment staff at the Maryland Technology Development Corporation, or TEDCO, here in Maryland. So I'm doing investments now, but I technically work for an economic development firm. So I'm a state employee working for an economic development firm, but I'm doing convertible notes, right? So I'm doing actual investments. So it's like this weird quasi-government situation. And so I'm there and I'm doing seed investments on all kinds of technologies. I'm doing all kinds of things, but only for companies in the state. And this is in 2016. And so when they hired me, one of the issues they had internally was investing in black-led companies. So while I'm there, like less than 6 months on the job, I show up to work one day with a proposal to start a pre-seed fund to invest these companies earlier than anybody else. And I had gotten a black-owned bank in Baltimore, the Harbor Bank of Maryland, to commit to putting up half the money for the first year. So when I show it to my bosses, they got to that part. They're like, "Oh, we see you got this bank here. Is this aspirational? Is this like a goal? Like what?" Like, "Oh no, they've already agreed to it. We got paperwork coming. We're all good." That's when they tell me I'm not allowed to do deals on behalf of the state of Maryland. I get into a bunch of trouble. I get put on probation, and then they tell me to go run this program. So I go.
So you get in a bunch of trouble, but they say, okay.
Yeah, I failed them half the money, right? Like they weren't going to say no. So they tell me go run it.
A classic better to ask forgiveness than permission move.
Exactly. The first year we end up doing 9 investments. The next year they re-upped. We did another 10. And then the next year, my team and I went before the governor and state legislators and got them to put $1 million in the annual budget, which was at that time the first and only state-backed pre-seed fund for women and minorities in the country. So I got to have fun running that for 3 years. And then in 2020, I quit my job and decided to start RareBreed Ventures. And I guess the claim to fame, the one thing everybody always goes to is I raised the majority of my fund one off of Twitter. So it's always a fun journey story there.
I read your testimony to the House of Representatives, which I do want to come back to, but I read through it and you mentioned in there that you had done, tell me if this is correct, 4,000 meetings with LPs for raising Fund One. Is that right?
That is correct.
That is just a staggering number of meetings.
Yes, it is. But when you're in it, you just kind of get into a flow state, right? Like it just is what it is. Like every day there's this goal of we got to reach this dollar amount, because at some point it's just desperation and survival. Because like I can't pay myself until I hit a certain dollar amount of commitments. And it's also happening at a weird time, right? So I'm raising my money and it's during a time of COVID and this like reckoning post George Floyd, right? So everybody's locked in at home, but we've gotten past the point of COVID where money stops. So like money's now flowing and everybody's looking for an outlet for communication and to talk. So like Clubhouse is now becoming popular and people are trying to find ways to communicate and stay engaged with each other while we're going through this COVID experience. So I was just able to get to a point where my calendar was just filled up with back-to-back Zoom meetings. I could do 28, 30-minute Zoom meetings in a day, right? It's 14 hours, right? Take 14 hours in my day, just boom, 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 boom. And so you have enough days like that, you get to 4,000.
That's serious grit. I love the hustle. I know it's early, but I love this serendipity of, you open this email after being on a list for 6 years that you've never read, and lo and behold, there's a role that you end up popping into. But at the same time, grinding your way through 4,000 meetings, getting that fund launched with the state and whatnot, and making your own luck. It's a great story. To go back to the House, so you were invited to speak about the Improving Capital Allocation for Newcomers Act, and I'm curious about the experience of that and the points you wanted to drive home.
It was an incredible experience to first and foremost be recognized as an expert in your field, whose voice is valued in our political process, right? Like that in itself is an honor, right? And then being forced to sit down and write out a full testimony, but then craft a 5-minute, like crafted speech of like, these are the points I need the members of this committee to leave with. One was just an amazing exercise for me to gain true clarity on my position, but also for me to understand like how this process works. And then the last part is to become slightly disillusioned and disappointed when you understand how the process actually works. Won't go into details here, but just know like it is an honor to take part of our political process, but change comes very slowly. And slow change can be frustrating, but that doesn't mean change won't happen. So, you just got to keep doing your part to see change come. And what I was driving home, the ICANN Act, really is an expansion on an expansion that they actually put in the I am blanking. Y'all can edit this. Y'all want to, so choose. In the Jobs Act, where there was a provision that allowed for you to raise, and generally speaking, if you're raising a fund, whether a venture fund, private equity fund, what have you, you can raise an unlimited amount of money from no more than 100 people. Those people are limited partners or LPs, right? Your limit's 100. You yourself are supposed to be one of the investors, so really your limit's 99. You can raise an unlimited amount of money, but only from 99 people. That becomes tricky when you start talking about really large funds, right? So if you're raising a $10 million fund from 99 people, that means from 100 people, that means the minimum check or the smallest check anybody can write you is 100,000. Understanding a $10 million fund is a very small fund. If you're doing a $100 million fund, that means the smallest check anybody can write you is $1 million. The amount of people in this country that can write $1 million check of money that they can't touch for 10 years becomes really small. And now if
to
we're
a
talking
single manager for a single fund.
For a single manager for a single fund, right? That's not a whole lot of people can do that. And keeping in mind, a $100 million fund is still considered a fairly small size fund, right? If you get to a $500 million fund, the minimum check now is $5 million. The amount of individuals who can afford to give up a $5 million check to one person that they can't touch for 10 years is extremely limited. So now you're forced to go to these larger institutions, right? And so that means if you want to raise money in this ecosystem, in this space, in this vertical, the people you can raise money from are limited to only these large institutional investors, these pension funds, endowments, insurance funds, large foundations and such, right? There's a very small pool of people who can do that. Well, in the Jobs Act, they put in a provision that expanded. It said if you're raising 10 million or less, you can raise from up to 250 individuals. So instead of the minimum check having to be 100K, your minimum check could be 30 million or less. It could be 30,000 or less. And now if you take that 30,000, tell somebody they can pay it over a 3 or 4 year time span, now you're talking to somebody paying 10,000 a year over 3 years to get you to 30,000. Like that's a really attainable entry point for somebody who wants to get into this asset class, because generally speaking, the dollar amounts are so large that they can't. Well, that provision was capped at 10 million. What the ICANN Act does is allow that provision to go up to, I believe it's up to 50 million. So saying you can raise a fund of 50 million or less from up to 500 people. So now if you want to raise a $50 million fund, your minimum check can be 100,000 or less, because as you supplement your fund, you're going to have some people putting bigger checks, some people getting smaller checks. That means now the individual investor at home who is only allowed to participate in public funds, right? Be in public markets. Or if they want to participate in private markets, they're always pushed to doing direct investments in the companies directly. That's a zero-sum game. You're either going to get no money or some money. That's it. Now you're getting the option, you'll have access and option to invest into venture funds where now your check is going to be spread out across multiple private companies, right? Now your upside is going to be lower than going into a company directly, but your upside is going to be higher than you putting it into public markets, right? It's just giving you another asset to put in your portfolio that's been out of reach. And so we are really excited for that. And then it also gives fund managers like me another option of people to go and raise capital from. If I'm saying venture capital is broken, the ecosystem's broken, the way we raise money is broken, well, the system's going to look at me like the system is what it is. Well, here's a way to start to change that system, right? And see systematic growth and also see more capital go into venture as a whole. That means more money going to startups. That means more innovation, right? Like all of this stuff gets positive impact. So let's hope that the iConnect gets passed.
I agree. I mean, we're both emerging managers, so we have our own interest in talking our book, but I will say supporting more competition among emerging managers, I think is great for innovation because it means more founders are getting backed. You see more innovation, more startups getting supported. But at the same time, it's keeping more pressure on bigger shops, right? Who, sometimes can coast on reputations from people who did work 20 years ago. And it just creates more pressure and competition across the board, which I think, everybody wins with. LPs win with that. Local startups win with that. And the country at large wins from more money going into innovation. So.
100% agree.
Yeah, to all the congressmen listening, hoping you're taking notes. I'm curious what you make of the current state of regulatory play, because I watch, there's some really interesting dynamics where you have the SEC right now very openly talking about raising the standards to be an accredited investor. And for people who aren't wonky, it's because originally when the accredited investor rules were set, there was no inflation adjustment included. And so the SEC's taken this view of, well, if you gross this up to where it was when this legislation was passed, or at least when these thresholds were set, you'd be looking at a much higher hurdle. Now, the issue with that is it makes it much harder for individual investors, much, much, much harder for individual investors to invest in venture funds, which runs against all the positives that we were just talking about. But then curiously, in Congress, you've got bipartisan interest, which is these days, it's so hard to find anything that you can find people on both sides of the aisle around who are like, actually, we want to make it more accessible for people to invest. And you see that from Republicans who, they used to be free market. I don't know what they are as far as markets now. But generally speaking, there's this vibe of we want to make private markets more accessible to individual investors for the reasons that you said. Like the returns potential is higher. And yes, liquidity is different and risk is different. But high level, there's appetite. And I'm curious, like, how do you, as someone who, it's not just observing, right? Because you're running a business that's directly affected by this. And I'm curious how you're thinking about, these different forces in play and trying to respond to that, running your own business where it's affected.
It's difficult because, so for context, I mentioned I started my career supporting the Department of Defense with a top secret clearance, right? So I have some very deep love and ties for America and for American intelligence, right? So when I say that because understand why politicians on one side of the aisle are scared of it and one side aren't. The ones who are scared, they're scared because there's so much money in the private markets. It's allowing companies to stay private longer and become bigger while being private. Well, that becomes really scary and dangerous for a country when your largest company in your country is completely private and you have no insight or oversight to what's going on. And so now let's say the CEO or let's say an executive at the largest company in your country that employs the most people now gets into some kind of side deal with somebody in China and needs to find a way out. That's how espionage happens on very, very large scales. Well, at least if a company's public, there's a certain level of governmental oversight that helps defend against it, doesn't stop it, but at least makes the government feel more comfortable about it, right? That's why you're having the issue of the TikTok ban. Like, look, y'all, like everybody can feel how you want to feel about TikTok. There are real security issues at play, and security issues in ways that people will never consider, right? And so on one side, you have people saying, hey, we don't want you to we don't want but so much money to be in the private markets, because now the private markets can be so large that people don't need to come to the public markets. And when people don't need to come to the public markets, we can't force oversight. So they're trying to force people to public markets sooner so they can get oversight sooner, which the reason that the rules are the way they are is because they changed the rules years ago to make it more expensive to go public, which now led to more money being private, right? But to your point, on the flip side, it means over time we're going to see those forces fight against each other, where one force is going to be trying to choke out the other, right? To say, hey, you need less money over here, we need more oversight. And so that money and oversight things are going to battle out as we go. And I don't know what the solution is for it. I'm just here to ride the wave and make the best investments I can.
Fair enough. So turning to investing, I want to read to you something from your website. You mentioned some of these entrepreneurs are building products and serving communities that many traditional VCs do not understand or are not willing to understand. Can we unpack some of that? And particularly, I think the not willing to understand, I'm like, oh, I want to hear more on that. I want to get Mac rolling.
So I posted about this recently on Twitter, where it's a thing of, if you're hearing a pitch and a founder says, black hair culture, right? The moment they hear black, a lot of investors go straightly to TAM of, okay, black people account for, let's call it 13% of the population. Black hair care, we're talking about people with long hair, so we're going to talk about women, so we're going to cut that in half. So now we're talking about 7%. Let's call it 7 to 6.5% of the population. Okay, we're talking small. I'm tuning you out already. And so now the rest of the pitch has been turned out because market size is too small. At no point did they hear how much, even though the size of the market is small, how large the size and dollar impact. And I don't think people truly believe that when they hear you're talking about this really small market, but they're spending so much more on hair that their actual dollar amount value is like quadruple what it should be. I don't think people actually believe that, right? Like, it's hard to understand. Like, I have a daughter who's not even 3 yet, and she has a bag of hair care products that if you added up all the products in that bag probably cost me $300. And I have to like refill that at least every 2 to 3 months. Right.
Well, right. As one of many bald middle-aged VCs, I can understand how we would undershoot on estimating how much hair care costs could be. Right.
So that's an example, but even for like a founder who may lean into, and I'm just giving this as an example because there are founders who lean into this and they get upset with me, and I'm just trying to help them understand like what's happening. They lean into the fact that like, hey, I built this originally for this community. I'm like, awesome. Is that what your solution solved? They're like, well, I built this solution for that community, but my solution solves this problem for all people. Okay. Well, but because you leaned into your pitch talking about this community, that is the only thing that investor hears. They automatically think small, and they have shut down everything else you have to say. A good investor should take the time to listen to everything this entrepreneur is saying, and at no point did this entrepreneur say that this product was only for this community. They said this community was the antithesis and what got them to start it, but that's not the only community they support. And so their TAM and their market size is actually much larger. And in some cases, the founders will tell you, oh, we're only making this for this community. And they feel that way in the moment because they're so passionate about it. But as they grow their company, they will have opportunities to expand beyond that. And we have seen this happen with many other companies before. But you have to want to give those founders grace in that moment to give them the okay to not be perfect. But as an investor, you see so many deals, you have so many founders. It's okay to just turn your brain off and say no to this founder because you're going to see so many others that you're going to be able to make an investment, whether you say yes to this founder or not.
What proportion of founders do you invest in are first timers?
It's like 50-50 at this point.
Startups that get referred to VCs on average get invested in 13 times more than direct cold inbound pitches. And referrals are a big part of venture. If you're running syndicates, you need to bring other people in to help you invest. But also networking and sharing deals is just a key part of the flow of how the capital gets through the system here. And these referrals, they get more weight because these deals are typically vetted, right? Relative to a random deal that comes in cold. A lot of those deals are tilted towards, second time or later founders. And a lot of those referrals kind of spin this loop of sameness, where people will refer deals from people they've worked with before, which intrinsically isn't a bad thing. Like in an abstract sense, you're like, well, that makes sense. But you end up in a loop where a lot of founders who get backed have very similar backgrounds. And I'm curious, you're doing a lot of first checks, you're a pre-seed. So in some sense, you're breaking the wheel, to use a Targaryenism, yourself with your own firm. But are there things that other VCs could be doing to try and break the wheel a little bit as far as getting away from sameness while also being realistic that referrals are going to be an important part of deal flow?
I think more investors need to not lean as heavy on their referrals as they do their own outreach. I don't think a lot of investors are good at outbound deal flow. I think outbound deal flow is a skill that is honed in the early parts of your career, where you're really hungry and you are trying to get any and every edge. I think about deal flow differently just because at one point in my career, my job was to find all the best founders of color in the state of Maryland. And I had to get really creative of where I would go and look. And so literally anything that had to do with tech or business, I was at, which included chamber of commerce meetings, which included like foundations having like local entrepreneurship conversations where they're talking about people starting their waste bead stand at the swap meet down the street, right? I was all those places because what I found is business owners know business owners. So even though I go to a chamber of commerce meeting and there's nobody in this event that has anything for me, there's somebody with an insurance firm who's got a cousin who's building this really cool tech thing. Can you talk to them? Right? Those are where you find some of the craziest, most unique companies. And then also, because it becomes too easy to just get into the same cycle of, I can go to the same local tech events that I go to, every Tuesday, Wednesday, or Thursday. I'm going to go to the same national events I go to every year, and I'll add 1 or 2 a year. So I'll do 10 of those. And then I have my influx of people sending me referrals. Well, I got more than enough deal flow to have to deal with for the next 4 years already built in, right? And to say, hey, I need you to go beyond the places you commonly go and to pick events and states you don't normally spend time in. Well, that takes extra effort. It's hard enough to get into this industry. It's hard enough to get into those circles. It's hard enough to identify what these events they are, like who your tribe is and what referrals you take credible, to then say, hey, now I need you to go beyond that. And that also means I need you to do your own vetting. It's a lot easier when you get some from your friend who works at Andreessen Horowitz, where like you can just tell somebody, hey, I came from somebody at Andreessen Horowitz. Nobody's ever going to question your vetting. But you go to somebody like, hey, I found this really cool company in Memphis, Tennessee, and everybody's going to be like, okay, who else has ever heard of it? We're the only ones who know about them. Is that a good thing or is that a bad thing? It depends.
It depends on the LP. It depends on the LP, right? Some people, they're like, love it, but probably most, they love the warm confirmation bias of hearing that A16Z is involved.
And so that's I think that's the difficulty. So for me, it's really about how you think about your deal sourcing and becoming more proactive in it. And being able to look and take different approaches. Like I'll tell you, the company I just mentioned, the one in Memphis, came from from seeing a case study on the website of a design firm that another one of my companies was working with. Right? Like it's a very unconventional, unusual thing. And that may lead to being one of the largest investments I ever make in my career. Right?
How do you think about scaling your deal flow with your brand as it grows, but your personal brand, the firm brand? I realize the overlap there is very high right now, but as that scales and people, more and more view you as someone, hey, we really would love to work with Mac. And, you have such a wide geographic mandate now too. You're open to working with first-time founders, first checks. Like I'd imagine you're flooded. So how have you scaled that so far, and how are you thinking about that in the future?
Being able to quickly go through companies and being able to quickly get to, a no, not a fit, or, not right now kind of thing. Trying to get to those quickly, having, a good system for setting up those first meetings and follow-up meetings, and being okay with not seeing everything. So understanding it. And so it's different. I think people talk about venture as a monolith, and we're not, right? We really should talk about the skills in venture at different stages, right? Because what it means for deal flow at Series B is very different than what it means for deal flow at pre-seed, right? If I'm a Series B fintech investor, I know the 300 fintech companies that raised Series A last year. And I know I got to follow those. And I know I got to figure out which of those 300 is the top one or two that we're going to invest in, and how do I build that relationship, which is very different from if I'm a pre-seed fintech investor, there is a new pre-seed fintech company popping up every 10 seconds. I just need to make sure I get into the places where I find the pockets and pools of the most talented folks, and hope I get some that bubble up. And that's going to be some combination of ecosystems in terms of locations, certain specific accelerators or programs, and then certain individuals and like angel groups, right? So it's just about being able to quickly disseminate, and then as I build my team, making sure my team members have that same skill set, or building. And I'll be honest about it, right? Like I can evaluate a business with the best of them, but I'm more qualitative than quantitative, right? You got to use both, but there's something to using your instincts in this industry, and the instincts or pattern matching that comes with time, that comes with seeing a ton of deals. So there's an advantage to seeing a ton of deals. So having my teammates and team members seeing a ton of deal flow early in their career, so they can help build that internal barometer and teach them how to trust that. Right? I actually honestly do believe that makes you a better investor, because what you notice and what I've seen is investors who are truly 100% tied to their model and data driven, they tend to do really well. But what it tends to do is it tends to lower their ceiling, because they always tell you their biggest misses were companies that they love, with founders they love that didn't fit the model. And I think there needs to be a balance there, right? It can't be full on one way, full on the other. You need some information, because the information is a proxy for execution. Your information and me doing my due diligence lets me know that you have the ability to execute and that you're not lying, right? But then some of that are like, there's something about this that feels different. Like I've seen a ton of companies in this industry. You've come at it from a different angle. You've taught me something different. Your customers respond to you in a way I haven't seen before. Your branding, like those are the things you pick up over time that I believe a good investor leans into as they go.
When your founders call you, text you, email, what are the themes that they're most coming to you for help with?
I need to vent. Okay, no. Let's do number one. I need money. It's always number one. It's the top of the list. I need to vent. I'm struggling with an investor or board member. I'm struggling with an employee or a co-founder. I need money. Those are the things that I get calls and texts for. The I need money or I need to vent are like the highest up there, followed by issues with board members or co-founders.
With the I need money, something I'm curious, coming off of, your emerging managers early, feedback I had from a couple LPs, my own fundraise, was how much time have you spent building relationships with firms at Series A to help facilitate future raises? And I'm curious, how much time have you spent? Now you're further along than I am, but how much time have you invested in trying to go further in the other direction of where you've been focused to help with the I need money part from your founders?
I'm doing more and more of it as my portfolio matures, right? Like, and it's not even just Series A funds, it's also like growth funds. Like, okay, when they get to their Series B, they're still calling on me for help. When they get to their Series C, they'll still ask me for introductions. Like, I'm not going to be the investor with the biggest list, spreadsheet of Series C investors. Like, their Series B investors should be that. But they're still going to expect for me to have some of those relationships, right? And so I find myself building relationships now with seed investors that also do Series A, right? So these are people I can hand off and they can ride to the Series A or it can be leads. And then on the other side, large multi-stage firms. So I can get my founders to start building early relationship with the large multi-stage firms that are going to become important for later. And then having the relationship with the seed Series A firms that I can do the natural handoff to as they go up the ladder, right? That's the way I think about it. But at the same time, I'm connected to over 5,000 VCs all across the globe. And so it's just becoming better systematically. Having better infrastructure internally to manage how I send out and share deals. Because that's the other thing, right? You can't share every deal. You want to share high quality deals. Certain firms you can only send certain types of deals or only like your top 2 deals you have in your entire portfolio. You can't send them anything else. So for me, and I think for emerging managers, is getting good internally with the internal infrastructure to be able to manage those co-investment relationships and legitimately spending time on them.
How do you approach portfolio construction?
I approach it so for me, I take a highly diversified, high number, low dollar amount strategy, right? It's very much in the wake of 500 startups, Techstars, a Liquid 2 type of strategy. Or even Ulu Ventures has a similar strategy, but they have more specific numbers. And so what I'm thinking about is, what's the largest check I can put in the earliest? What's the largest reasonable check I can put in at the earliest stage to get the biggest impact from the largest multiple, right? And so that's really to say, at the stage of this company, if I put in $100K today, at this largest multiple output of, let's call it 100x, can I return my fund? So I'm not necessarily thinking so much in terms of ownership percentage as much as I am thinking about the potential multiple from the stage I'm investing at. And that's because I'm writing such small checks that me worrying about ownership doesn't make sense, right? I get myself caught up in the wrong game. And so then now it's like, okay, I know I'm going to have a fairly large portfolio, and I know most exits in venture happen between 20 and 100 million. But that's where the vast majority of all exits happen. So I know I'm going to say roughly I'm going to do 50 deals. Of those 50 deals, I need 10 of those to fall into the average range for me to do 1 to 3x of that money. So like in a $10 million fund, let's say I need, 10 of these deals to return me back. Let's call it 1 to 3 million, 100K checks, 1 to 3 million. And then I'm going to need 5 of those deals to return me the rest of the money. I'm going to need 4 of those deals to return me my upside, and 1 of those deals to return the entire fund. Right? If I can get 15 out of 50 deals do well, with 1 of them returning the entire fund, I can have a successful fund. Right? And so really then it just comes down to, am I picking the right companies that I can get to that one, or multiple ones? And so when you think about it, I mentioned 500 and Liquid 2 very purposefully. 500 startups, Fund 1, $50 million fund, 150 companies, 160 companies plus, 180 companies plus, 11x and counting. Liquid 2, $50 million fund, 150 plus companies, 30 unicorns, 10x and counting. Right? Like, that's the strategy that I'm going after, and that's the way I think about it when I think about portfolio construction. But there's a lot of different ways to think about. There should be a lot of different ways to think about portfolio construction, but too often in this industry, people get boxed into only one way of thinking about it. And I think that's actually, I think it's a trap. I think our industry is young enough that there's still room for innovation and other thoughts about the way we do these things.
Do you do follow-on capital, or is it all on your first check?
Mostly first check. We do follow-on, and we say we follow on to our top tier companies. But what I would say as an emerging manager and as a early stage manager, what follow-on typically devolves into is first come, first serve of the companies that are performing the best in your portfolio at that time, right? Like even when you say we have a follow-on strategy where we hold things in reserves, once you have a company that's in seed moving to Series A that's doing well, the first few ones that are doing that are going to be the ones you're going to do your follow-on to, because they're also the fastest movers. And your fastest movers are supposed to be an indication of success. That's not always true. And so it becomes really hard to have the discipline to be patient and say, even though this is one of our fastest moving and highest performing companies, I don't think that's going to be one of our biggest winners. And so we're not going to follow on, right? And so that's a much harder thing to do for emerging managers, and something that takes real discipline. And somewhere historically other funds have made the mistake of going from a fund 1 to a fund 2 of saying, hey, we're really good at first checks, so we're really good at picking winners. Well, it's possible to be really good at first checks and really bad at second checks. And if you're good at first checks but bad at second checks, you're going to have an underperforming fund, right? Because your bigger checks are going to be the second ones. So that means the larger portion of your fund, of your capital, is tied up to the ones that are underperforming, right? So that's a problem. And so the way we're thinking about RareBreed as we go into Fund 2 is one of the positions we'll be adding onto the team is head of platform. We're going to have a large portfolio. Like our portfolio is going to have over 150 companies in under 10 years, right? So I'm hiring somebody on my team whose job is to be 100% focused on the portfolio, who's in it, how they're doing, what they're doing, all that. And that's also going to be the individual who's going to be the point of contact for determining who gets follow-on funding. Because they're going to be the ones with the strongest relationships for how the companies have been growing. So they can be like, oh yeah, they're growing, but they haven't been, after this company got the funding, they stopped being as coachable. They didn't listen to these things. Yeah, they're raising money, but they missed these key metrics because they made these mistakes and won't own them. Well, I can lean on to that person for those insights to be smarter about follow-on, and also understanding that going from pre-seed to seed is not an indication of success. And going from seed to Series A, still not an indication of success, but closer. Series A to Series B, we're getting closer to something, right? So just following on from pre-seed to seed, there hasn't been an indication of success yet. There's just an indication of some execution and growth. So being disciplined of saying, hey, we're happy to do follow-on, but that doesn't mean we're going to follow on in the next round. Say, hey, we'll be around to help and support, but we're not going to follow on to the seed. But we're happy to follow on to the A if you get there. Right? That also takes discipline, and that takes real relationship building, because the founder can say no. Like, just because you have pro rata just means you have pro rata in the next price round. So once they get past that next price round, they don't ever have to give it to you again. And if you say you're going to skip that round, well, they can say, well, you lose it, right? But that means you have to build real relationships from showing that you can add real value. But also to think through, like, understanding my skill set is I'm really good at writing first checks. I'm really good at finding these diamonds in the rough. I'm still learning if I'm good at doing the second check part yet. And I want to make sure I'm being as thoughtful about it as possible and not making the same mistakes as some of those funds that I look up to as models of my portfolio construction. Right? Some of those funds have done poorly in the follow-on track. So it's like, how do you account for that? And that's what I'm working on.
Well, I think you've been pretty thoughtful about it for what it's worth. I'm mindful we're running out of time from what I told you we'd be doing. This has been really fun. I could dig into a lot more with you. One last one, and then I'll let you go. If someone listening, it could be a founder, someone who wants to partner with you, what's the best way for people to follow along with what you're doing or connect?
Best way to find me is on Twitter at Mac Conwell, MacConwell. I'm pretty active on Twitter. I don't reply to DMs as much, but if you send me a tweet that says you DM'd me, you have a better shot of me reading it. That does work. But the best place to get me is on Twitter.
All right. Mac, thanks so much.
Absolutely, Joe. Thank you, man.
Hi, Joe again. Thanks for watching the show. If you'd like more of this in the future, subscribe to our channel. If you'd like to learn more about Seaplane Ventures, just check out seaplaneventures.com. Cheers.